Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up. Now, if you're not on my email list, click the link associated with this video to get on it. And if you're watching this by having found it kind of randomly on YouTube, then you may want to subscribe to my YouTube channel to get my next video update, and also click that bell, and then YouTube will send you one of those alerts as soon as the next video is put up, because we're in some very interesting moments in the financial markets. Yes, we've had a tremendous stock market rally since March. It's almost all they talk about on CNBC and elsewhere, but there's other things outside the stock market that are very important to pay attention to. Most people don't simply invest in stocks, they also invest in bonds with a portion of their portfolio for diversification purposes. But we're in a strange moment where we're seeing some people get out of bonds and into gold and precious metals. And I want to show you why that's happening and why it's going to only accelerate going forward. So take a look at this chart here. This is the LQD Exchange Traded Fund. It's an ETF that holds corporate bonds. As you can see, this ETF had a dump in March and then rallied back up. It's rallied back up because the Federal Reserve is buying bonds. They have created a bond buying program. Without that bond buying program, the value of bonds would collapse overnight because many companies aren't making the money they were making before. In fact, many are in fact losing money. But they need the bond market to finance themselves, to borrow money, and so forth. So the Federal Reserve is propping the bond market up. Now that's creating a difficulty for people who want to diversify in the bond market because they can't make any interest. And the bonds are at a crazy artificial value because of the Fed. So the Fed's doing one thing, helping the economy, but it's making it difficult for people to diversify as they traditionally would because they can't make any interest in treasury bonds or corporate bonds or savings accounts. So it's really kind of a crazy situation. But this article explains the background of this. This is an article that was in the Washington Post about 3 weeks ago about the rise of so-called zombie firms throughout the U.S. economy. A zombie company is defined as a company that has so much debt that it's having to spend a vast amount of its revenue stream to finance that debt, and even borrow more money to finance the debt too. So economists have found that 1/4 of all American corporations and 20% of those trading on the U.S. stock exchange are now zombie companies. They have so much debt that they don't really have any money left over because they're financing it to innovate and be productive. And this is going to have long-term consequences for the U.S. economy. There's entire sectors of the economy, in fact, that are zombie sectors, such as the fracking industry. But this is also impacting everyday companies too that you may encounter in your personal life, shopping and so forth. Big chains are now zombie chains. They wouldn't be able to survive without the federal government stimulus and the Federal Reserve bond buying operations keeping corporate debt afloat. Without those, these zombie companies would collapse overnight. And it would be a horrible thing for the economy. Yes, they would end up being replaced eventually, but the government doesn't want to face the short-term consequences of mass bankruptcies. And I don't think the people donating to the politicians want it to happen either. But this rise of the zombie firm is really not simply a legacy or a creation of the shutdowns of the economy that have happened over the past couple months, but it's really a legacy of massive debt loads built up over the past 15 years. The low interest rates created by the Federal Reserve after the 2008 banking collapse and maintained from there on created artificially low interest rates that many American corporations took advantage of to issue corporate bond debt. They then used those proceeds to buy back stocks, thereby driving stock prices higher, making stock market investors happy, and also enabling CEOs and corporate bond members to exercise options and get out and make a lot of money over the years. But we're now saddled with this legacy of massive debts in zombie firms. So why is this all important? It's important because it's creating this current environment in which the Federal Reserve is propping up the bond market and making interest rates so low that bonds no longer make any sense from an investment standpoint and even a diversification standpoint because they don't draw any interest. And if a bill ends up being paid from all this, it's going to be a bill of the dollar falling in value and inflation exploding at some point in the coming years. And we've got to, I believe, be prepared for that. What types of investments go up the most in times of inflation? Well, the ones that do, if we look back to the last period of high inflation, the 1970s, gold did the best, and then energy and oil, commodities, and then real estate. So those are three investment asset classes I think are something to keep in mind over the next decade. I'm not personally investing in all of them. I don't think now is quite the time for all commodities or for energy, but I do believe that now is the time for gold. And this chart of gold here shows you why. Look at what gold has done this year. Gold has been outperforming the S&P 500 and the U.S. stock market. Gold fell less than the stock market did in March and then rallied quicker than the stock market did to new highs. And gold is now testing its all-time high right above 1,800. And the right gold stocks have been simply exploding up in value to be among the top performing sectors in the entire stock market. One of the best performing stocks in the entire S&P 500, for example, is Newmont Mining, a stock that, yes, I do have a position in, and it pays a nice dividend, a dividend bigger than you can get in a CD, bigger than you can get at your U.S. Treasury bond, and bigger than you can get in a safer corporate bond. The only way you can get a bigger dividend is if you bought a really risky, pure junk bond, not something I want to get involved in. But if we step back and look at a long-term chart of gold, we also see something very interesting. Gold last made a peak, excuse me, in 2012, and it fell for years. In fact, the indicator at the bottom of this chart trended down until 2018. That's a relative strength indicator comparing the price action to gold to the S&P 500. It trended down when gold lagged the S&P 500. And because it did that for such a long amount of time, many people forgot about gold completely. The media stopped talking about gold pretty much throughout all those years. And it just fell off the radar screen of the individual investor, especially in the United States. But then, starting around the fall, October of 2018, gold started to outperform the U.S. stock market. This relative strength indicator began to trend up, and gold has been beating the U.S. stock market ever since. That's why this March, when the stock market pulled back, gold fell less than the stock market, then came back faster than the stock market. And really, if you want to beat the markets, that's how you want to do it. You want to be in the sectors and asset classes that are beating the markets. To beat the markets, you want to be in what is beating the markets. In gold now, with what is going on in the bond market and rates being so low, I believe is a necessary investment for diversification purposes. When the typical investor would say have half their money in stocks, half their money in bonds, now I believe it makes no sense to have half that money in bonds, but to devote a portion of that half into precious metals. That's what I'm doing with my money. I'm devoting a portion of it into precious metals and then another portion of it into mining stocks, because mining stocks will go up even faster than gold goes up. Some of them pay dividends, and there's even a whole arena of small cap mining stocks that will even go up bigger or faster than the big cap mining stocks. I believe we're in a new gold mining stock bull market, much like we saw in 2002 and 2003, when that was the start of a cycle then. I think we're in a similar moment, something I'll talk about in more detail in a future video. But this is what's going on in the markets. If we look outside the U.S. stock market, really the bond market is perhaps the most interesting thing. If rates at zero, no, you can't. The bonds don't make much sense as an investment, so we got to look at alternatives. And an alternative is gold and silver. They're beating the U.S. stock market too, making them also an attractive trading vehicle. So that's what I got to say in this video update, and I'll be talking with you later. Subscribe to my email list, subscribe to this video YouTube channel, and I'll be speaking with you later.